Hello and welcome to AFM 451. In this video, we walk through the audit journey from understanding risks all the way to forming an audit opinion using a banking institution as our example. Every audit, as we know, begins with understanding the business of the auditee or the client. Consider a mid-sized commercial bank. It earns revenues from interest on loans, service fees, and of course, investment activities. It manages deposits, extends credit, trades security, and operates through a relatively complex IT system. We study its financial statements, regulatory environment, governance structure, and the incentive systems as a part of a typical financial statement audit. The objective is simple: understand where things could possibly go wrong. From there, we would identify inherent risk at the financial statement assertion level. For a bank, loans receivables raise valuation risk. Are credit losses correctly estimated? Deposits raise completeness risk. Are all customer balances recorded? Trading securities raise questions about existence and valuation. Revenue recognition raises issues over occurrence and cutoff. At this stage, we're not testing yet. We're simply mapping the risks to the relevant assertions. Next, we assess the magnitude of those risks. A small branch error is not equivalent to a material misstatement in the loan loss provisions. We consider materiality, complexity, management bias, and susceptibility to fraud. High volume automated transactions may reduce certain risks, but amplify others if system controls fail. Once significant risks are identified, we determine whether relevant controls exist. In a bank, this might take form of automated credit approvals, segregation between loan origination and loan approvals, independent review of credit loss models, reconciliation of deposit balances, and of course, IT general controls over systems. If controls related to significant risks are present and designed effectively, we would like to test them. We inspect the evidence of approvals, we would reperform some reconciliations, we evaluate the model valuation process. If controls operate effectively, we may reduce the extent of substantive testing. This is a reliance strategy grounded in sufficient and appropriate evidence. If controls, on the other hand, are weak or absent, the risk of material misstatement increases. In that case, we would expand substantive procedures. We confirm loan balances, independently recalculate expected credit losses, perform analytical procedures over interest income trends, and directly confirm deposit balances with consumers. Throughout this process, we continuously assess whether controls meaningfully reduce the risk. If they do, we revise the audit program accordingly. If they do not, we adjust our substantive procedures to obtain more sufficient and appropriate evidence. Execution then follows. We would perform the test of controls where reliance is appropriate. We would perform substantive analytical procedures and test of details where needed. We document our findings, reassess risk continuously, and refine our approach as evidence accumulates. Finally, we evaluate the results as a whole. Are misstatements isolated or systemic? Do they exceed the materiality thresholds? Are disclosures adequate? Does the evidence support management's representation? The audit culminates in the formation of an opinion. Based on evidence gathered and the risks addressed, we conclude whether financial statements are presented fairly in all material aspects. Ultimately, the sequence from risk to audit procedure is a dynamic interplay. Professional judgment is at its heart. It demands that auditors not only see the process but also deeply understand its significance. Keep this structured thought process in mind. It's a foundational skill for any aspiring auditor. By mastering this, you strengthen your capacity to deliver reliable, high-quality audits. Thanks for following along. Take care, stay safe, and bye for now.